Strategy Management Series. Video number 54, Strategy Formulation. Step 4, Internal Performance Evaluation. Welcome back to the Ready MBA series on strategy management. In our previous videos, we introduced the 8-step framework used in the strategy formulation process and covered steps 1 through 3, which addressed mission, vision, values, strategic intent, and external analysis. We also kicked off step 4 of strategy formulation, internal analysis. Internal analysis involves evaluating and assessing an organization's internal resources, capabilities, and performance to understand its strengths and weaknesses, and identify competitive advantages. Competitive advantages are unique attributes or set of strengths possessed by a company that allows it to outperform its competitors, achieve superior performance, and attain a stronger market position. These advantages can be based on various factors, such as cost leadership, differentiation, innovation, operational efficiency, customer loyalty, or exclusive access to resources. A sustainable competitive advantage provides a company with an edge that is not easily replicated by rivals, enabling it to succeed in its industry and create long-term value. As discussed in our previous video, the internal analysis framework is composed of 7 parts: internal audit, organizational culture and structure, financial performance, resource analysis, benchmarking, capabilities, and definition of strengths and weaknesses. In the previous video, we explored the first 2 parts of the internal analysis, the internal audit and organizational culture and structure assessment. In this episode, we will cover the next 2 parts of the internal analysis, financial performance and resource analysis. Together, they help organizations assess their internal resources and capabilities to identify areas for improvement, and gain a competitive advantage. Let's dive in. Part 3, Assessment of Financial Performance. The third part of the internal analysis involves assessing the company's financial performance. This step is crucial in understanding the organization's profitability, liquidity, solvency, and overall financial health. The planning team reviews financial statements, key performance indicators, and financial ratios to identify strengths and weaknesses in the company's financial position. They examine factors such as growth, profitability, liquidity, leverage, and activity ratios. By analyzing historical performance and comparing it to industry players, the team can gain insights into the company's financial capabilities. Let's take a quick look at each one of these groups of ratios. 1. Growth ratios. Growth ratios provide valuable insights into the company's ability to expand, generate revenue, and increase its market share. Businesses can gauge the effectiveness of their strategies from growth ratios such as revenue growth, profit growth, and market share growth. They can also identify areas for improvement, and make informed decisions about resource allocation and future initiatives. 2. Profitability ratios. Profitability ratios are used in strategic planning to evaluate a company's ability to generate profits relative to its various operational metrics. They provide insights into the efficiency and effectiveness of a company's operations and its ability to convert sales and investments into profits. Profitability ratios such as gross profit margin, operating profit margin, net profit margin, return on assets, ROA, and return on equity, ROE, allow businesses to assess their financial health and identify areas of improvement. They also enable informed decisions about pricing strategies, cost management, and resource allocation. 3. Liquidity ratios. Liquidity ratios play a crucial role in strategic planning by assessing a company's short-term financial health and its ability to meet immediate financial obligations. These ratios provide insights into the company's liquidity position, indicating whether it has enough readily available resources to cover its short-term liabilities. Ratios like the current ratio and the quick ratio help businesses gauge their ability to manage cash flow, pay off debts, and handle unforeseen financial emergencies. Liquidity ratios allow companies to ensure they have the necessary financial cushion to support ongoing operations, make timely payments, and take advantage of strategic opportunities without risking insolvency or disruptions in their business activities. 4. Leverage ratios. Leverage ratios, also known as financial leverage ratios, are crucial in strategic planning as they offer insights into a company's level of debt relative to its equity and assets. These ratios, such as the debt-to-equity ratio and the equity ratio, help assess the company's financial risk and its capacity to handle debt. Strategic decision-makers use leverage ratios to determine the appropriate balance between debt and equity financing, optimizing the company's capital structure for growth while managing financial risk. This analysis aids in making informed choices about funding options, ensuring that the company's leverage aligns with its strategic goals and risk tolerance. 5 activity ratios. Activity ratios, often referred to as efficiency ratios, play a significant role in strategic planning by offering insights into how effectively a company is utilizing its resources and assets to generate revenue. These ratios include metrics like inventory turnover, accounts receivable turnover, and asset turnover. By analyzing activity ratios, strategic planners can identify areas where operational efficiency can be improved, such as reducing excess inventory or optimizing the collection of accounts receivable. These insights help in streamlining processes, managing working capital, and enhancing overall operational performance, which in turn contributes to achieving the company's strategic objectives and financial goals. Part 4: Resources. Evaluating resources is another crucial aspect of internal analysis. The planning team identifies and assesses the tangible and intangible resources available within the organization. These can include financial capital, human capital, intellectual property, technology, and brand reputation. Techniques such as resource-based view and value chain analysis can be employed for this purpose. Resource-based view involves identifying and analyzing a company's unique resources, both tangible, physical assets, infrastructure, and intangible, brand reputation, patents, and assessing how these resources can create value and differentiation in the marketplace. The RBV framework helps companies build a sustainable competitive advantage by leveraging their distinct resources to develop strategies that are difficult for competitors to replicate. This approach encourages businesses to align their resources with their strategic goals, identify gaps in resource allocation, and invest in areas that can yield long-term success. Value chain analysis, on the other hand, examines the sequence of activities within an organization's operations to understand how value is created for customers. It helps identify primary and support activities that contribute to the organization's competitive advantage and efficiency. By analyzing each activity's costs, value added, and potential for differentiation, a company can identify areas of competitive advantage and inefficiencies. This analysis helps streamline processes, enhance value creation, and align activities with overall strategic goals, ultimately improving the company's competitiveness in the market. Both RBV and value chain techniques provide valuable insights into a company's internal strengths, weaknesses, and areas for improvement, enabling strategic decision-making and resource allocation. Conclusion. The internal analysis process helps organizations understand their strengths, weaknesses, and areas for improvement within their internal environment. By conducting a thorough analysis of resources and financial performance, companies can make informed strategic decisions. It is crucial to compare the company's performance with that of competitors and project into the future, considering the elements identified during external analysis. This holistic approach enables the planning team to envision the company's evolution and align resources, skills, and strengths to achieve strategic objectives. That concludes our discussion of the 4 initial parts of internal analysis in the strategy formulation process. Thank you for joining us. In our next video, we will delve into the 3 remaining parts of the internal analysis: benchmarking, capabilities, and definition of strengths and weaknesses. See you later.